Welcome to today's Explainer, where we are cutting straight through the noise, the endless hype, and that algorithm-driven financial advice you see everywhere to reveal the actual, real math of building wealth. We're going to look at the numbers no one really talks about and expose the invisible mechanics that determine whether you actually end up financially free or if you just stay stuck on the hamster wheel forever. So let's jump right into this big question. Why is it that you can get a good salary, get approved for a mortgage, diligently follow all the conventional wisdom, and still feel completely underwater? Well, the answer is that the rules of the game have fundamentally changed, but the advice we get hasn't. Today, we're breaking down the 5 invisible laws of wealth. These are the laws that separate the people who quietly build real financial freedom from the people who just look wealthy on paper. All right, let's kick things off with Law 1, sequence over selection. In other words, the optimal order of your money.
Listen, the order in which you invest matters far, far more than what you actually invest in. Most people obsess over picking the perfect stock or timing the real estate market perfectly. But the real secret is actually following a strict, step-by-step financial ladder. Because if you skip that starter emergency fund, the very first time your car breaks down, you'll eventually end up liquidating your investments at a loss just to pay for it. But if you capture that employer match in step 2, you are guaranteeing an immediate 50 to 100% return on your money before the market even does a thing. There's absolutely no stock on earth that guarantees that. And high interest debt, that is a guaranteed negative 20% return. You literally have to eliminate that before you go chasing a 7% market return. Now, if you follow that sequence early, your money does something absolutely incredible, thanks to the ski jump effect of compounding. You know, our brains are wired to expect growth in a straight line, but compounding builds a curve. The early saver who aggressively funds their accounts for just 10 years and then stops completely will mathematically beat the late saver who invests 3 times as much money later in life. Why? Because in that final decade, the growth just explodes. Time compounds so much harder than money.
Moving right along to Law 2, the two-way lever, which is all about the real cost of leverage. Leverage is arguably the most powerful tool in finance, but you have to remember it acts as an amplifier that runs in both directions. Think about 2 totally different bets using the exact same starting capital. You've got Jake, who uses 5-to-1 leverage. His $50,000 controls a $250,000 asset. Then you've got Marcus, who buys $50,000 of physical gold. No leverage, no income, and it mostly just acts as a really expensive paperweight that gets taxed as a collectible at 28%. After 20 years, Jake walks away with substantially more wealth. The reality is, leverage is a rocket ship when assets appreciate, but gold merely acts as crisis armor. It yields absolutely nothing along the way.
But hey, leverage is definitely not free. Let's take a $280,000 home in 2026. The old rule of thumb always said to spend no more than 28% of your income on housing. But that rule violently breaks down once you factor in property taxes, insurance, private mortgage insurance, and a realistic maintenance reserve. A mortgage pre-approval is not the same thing as true affordability. A $2,700 real monthly cost is the math the mortgage industry really hopes you overlook.
And remember how I said that amplifier of leverage runs in reverse too? Well, if you use a 2-to-1 margin loan to buy stocks, the market only needs to drop 29% for the bank to trigger a margin call. They will forcefully sell your position to protect their loan, totally wiping you out permanently, right at the absolute bottom, exactly when a little patience would have saved you. Leverage does not forgive.
Okay, let's shift gears to Law 3, the tax illusion, where we look at the illusion of tax breaks.
This right here is where behavioral psychology meets the IRS. Think about Maya with her traditional 401k. Her balance looks huge on her screen, but it's an illusion. She is going to pay taxes on every single dollar she withdraws in retirement, and she faces mandatory government distributions at age 73 whether she actually wants the money then or not. Now look at James. He pays his taxes today to fund his Roth IRA. Sure, it hurts a bit now, but his balance is 100% real. When he pulls it out, he keeps every single cent, giving him total immunity from whatever the government decides to do to future tax rates.
So what does this all mean? The choice between these accounts isn't just about your paperwork preference for today. It is a massive bet on what the government is going to do to tax rates over the next 3 decades to service its $35 trillion national debt. If you think taxes are going to have to go up to cover that massive deficit, locking in today's tax rates through a Roth isn't just paperwork, it's a literal shield for your future wealth.
Which brings us to Law 4, the crowd is not evidence. This is the timing and stock trap.
Our brains completely trick us into making terrible market decisions, mostly because we feel the pain of losses way more intensely than we feel the pleasure of gains. And this leads to massive unforced errors. Research consistently proves that an unlucky investor like Bridget, who constantly buys at all-time market highs, actually outperforms a disciplined investor like Wendy, who sits in cash just waiting for a 10% dip. Why? Because missing the market's best days destroys your overall return. And ironically, those best days usually cluster right after the absolute worst crashes. Wendy is paying a massive hidden cost in loss compounding and inflation while she waits around for a dip that might not come for years.
And speaking of the stock market, prepare to have your intuition totally challenged here. Astonishingly, a comprehensive study looking at the years from 1926 all the way to 2019 found that exactly 4% of U.S. stocks drove the entire net wealth creation of the stock market. The other 96%, they collectively performed no better than safe, boring government bonds.
Now, that is the true mathematical argument for index funds. Since almost nobody can predict that elite 4% of winners in advance, you simply buy the whole market. However, you really need to be aware of what you're actually holding today. An incredible 41% of the S&P 500 is concentrated purely in technology stocks right now. This means when you buy the broad market today, you are making a massive, highly concentrated bet on big tech, whether you realize it or not.
And you've got to remain deeply skeptical of the crowd. When a crowd mentality takes over, value completely disconnects from price. Just look back at the peak of the dot-com bubble. Investors eagerly paid a price-to-earnings ratio of 44 for the S&P 500. They paid more than 2.5 times the historical average for every dollar of corporate profit, simply because everyone else was doing it. Mistaking the crowd's enthusiasm for actual evidence is exactly how generations lose their wealth.
Finally, let's look at Law 5, respect the invisible engines. This covers bonds and the raw math of survival. I know, bonds sound incredibly boring, right? But they are literally the invisible engines running the entire global financial system. If you don't understand the bond market, you really don't understand money. Here's the absolute basic truth. Bond prices always move opposite to interest rates. Falling bond prices and rising yields reflect a loss of trust in a borrower. When short-term rates become higher than long-term rates, which is an inverted yield curve, it's the market's ultimate warning light. In fact, it has predicted every U.S. recession since 1955. And when those rates rise too fast, trillions in existing debt lose value. That exact mathematical reality is what caused Silicon Valley Bank to collapse in just 48 hours. So the whole point of investing is really just survival, because the math of recovery is brutal. Losses and gains are not symmetrical. Think about it. If you lose 50% of your portfolio, you don't just need a 50% gain to recover. No, you need a 100% gain just to get back to where you started. If you lose 90%, you need a staggering 900% return. The whole grows so much faster than the loss itself.
And that's because compounding really only has one fatal enemy. And that enemy is zero. Every single law we've covered today is basically a chain of multiplication. Multiply that chain by zero, even once, and the whole shebang collapses. Sizing your bets so that one bad outcome doesn't completely wipe you out is the only way to stay in the game long enough for the magic of compounding to actually work for you.
So as we wrap up this explainer, I want to leave you with a provocative thought to challenge how you view your own financial decisions going forward. Next time you make a move with your money, ask yourself, are you looking at evidence? Are you looking at a crowd? Because separating those two things is the true invisible law of wealth. Thanks for joining me on this deep dive into the real math of money.